There doesn't have to be a reason. I guess that's what I'm always trying to emphasize. And I'll stop saying I guess now. There doesn't always have to be a reason for what you're seeing. Asking why is irrelevant. It really is. Most of the time. I mean, obviously, if the market's in total free fall or total uproar, you would want to know if something happened. Something big happened. The Fed announced a rate cut and no one was anticipating it. Something to that effect, right? Which isn't going to happen, but you know what I mean. Then, yeah, you sort of want to know the why, but it doesn't really matter even then because the market's going one way or the other and you can see it in free fall or in rapid up mode and you just don't step in front of it. You either go with it or you stand aside because you don't understand what's happening. So, yesterday we have movement. I mean, is there a why behind it? Yeah, there's a why behind it, but the why is irrelevant to you trading it. All you're concerned about is how is the volume behaving, where is the pressure, where is the path of least resistance, where are the prices which are holding, and where are the prices which are giving way, and how do you anticipate it reacting in this current area? Because a lot of it will be a domino effect. A lot of it will be not fundamental news that causes the market to break down 20 ticks, but fundamental news which causes it to break down 8 ticks, which then sets off stop orders, for whatever reason. Either it may be a level people are watching, or it may simply be outside of people's comfort zone in terms of risk. But basically, the stop orders are orders which feed on themselves, and the market cracks 20 ticks or 25 ticks. And people say, well, why did it do that? Well, it did it because people were selling. I mean, that's the reality of it. Well, why did the market rally? Because people were buying. I mean, that's all there is to it. Why did this market sell off this morning? I'm telling you why it sold off. It sold off because nobody wanted to step up and really punish, short trades up here. They didn't like it from the buy side going to the high. And everybody saw that big order in the 5-year hold really firm, and so some sell orders hit. And then you saw the market fluctuate up there for, I don't know, a long time, right? I mean, maybe even an hour, or at least 30, 40 minutes. When people see that, it just takes the steam out of the move. And they start sitting on the sidelines, or they start going the other way. They sense weakness on the buy side, and they start pressing. Or if they're long, they realize they're not going to get paid. The market's not going to press highs. And if I'm in long trades, I need to work out of these long trades because I'm not going to get paid. If I'm in a spread, I need to start adjusting my spread to compensate for that. And that's all there is to it, really. So, sure, there are days, like I said, if it's a Thursday before unemployment with zero news except jobless claims, it might be slow. It might be a tough trade. But then again, I've come in on Thursdays before unemployment and there's been no news. And right off the bat, you see some action, and it makes for a good trade. You might have an hour or two of great trading. The most reliable are holiday weeks. Those usually are not very good. And Fridays before a 3-day weekend, like we saw last Friday, usually pretty choppy and nasty. The day of the Fed announcement, or if somebody's speaking. If a big guy is speaking at 10 a.m., or yelling, not necessarily a guy, could be yelling a woman, but if someone is speaking and the speech is considered to possibly have an impact on overall policy and dynamics, and the speaker is at 10 a.m., then yeah, the market may be completely dead from 8 a.m. to 10 a.m. for that person to start speaking. So those are the types of days that you can plan for a little bit in terms of slowness. But a day like today, you can't see it coming. Or a day like yesterday. You log on after a 3-day weekend and after a week where the market stayed in the same range 4 days straight, and all of a sudden sellers just crush it, and the domino effect happens and they take it down. So yesterday you have all this great action. You come in today going, okay, let's have day two, round two of this, and instead, no, we don't really want to play today. We'll just take a break today. That's okay. And yeah, man, maybe we'll wait for FOMC minutes. So it's just extraordinarily unreliable in terms of day-to-day action. All you can do is just show up and try to look for good spots and good volume and trade it to the best of your abilities. And yeah, I get this. The comment is, this is what tends to make us start looking at other markets while looking at the 10-year, because you have something that dies substantially. And I get that. It's just, it's all the reasons that I cover in all my material. I won't go into it today. I do get it. It's just that if the ES was such a great trade, again, more people would be rich. You know what I mean? It's just not, you don't have those same spots usually in the ES like that. I mean, that's just such a, it was really just such a great short trigger with minimal risk and everything kind of working in your favor. And in the S&P, it's like you almost never have a setup like that. You either occasionally you catch a run as it begins to take off and it just never comes back on you. But usually it floats around in a 4 or 6 tick range and there's no reliability, and it moves so fast that you just, you either get stuck or you just have to place a stop order that gets automatically triggered. The risk to reward scenarios just are not as good from a long-term perspective. Although you can also obviously see how watching volume applies in the S&P. I mean, it definitely does. There are clues as to when it seems to be running out of steam. It's pretty hard to pick the reversal to the tick in the S&P, whereas sometimes you can do that in the Treasuries. And it's also easier sometimes to just scalp, make 2 or 3 tick scalps in the Treasuries that you would never be able to do in the S&P. Or not with any conviction, anyway. Aside from the S&P, I mean, you could watch currencies or corn or something, but your commissions are double or triple. Volume's a little bit lighter. Plus, you can get out of the zone. You're in the zone trading one product and then for 2 hours, and then you try to hop over to something that doesn't behave in the same fashion, and now you're trying to trade it like you trade the Treasuries. Or you're watching the S&P and then you go to look at the Treasuries and you're like, I can't do this, it's too slow. And you go back to the S&P, and over the next hour and a half while you're watching the S&P, the Treasuries have a move. That would have been a very easy move for you to capitalize on, but you can't because you're not watching them because you gave up on them. So, but as far as that goes, that's to each his own. Whatever you choose to do. The idea is just to take the information and apply it. Question: if we're waiting to see evidence of what the big traders who can move a market are doing, what are they waiting to see before they jump in? Where does the size that creates continuous flow come from? Okay, so I'll try to be brief with this. That's something that I definitely discuss in more detail in the very beginning starter videos. But essentially, you have a broad range of individuals who work for predominantly banks, and not like Bank of America necessarily, but Goldman Sachs, JP Morgan, those guys. And you also have guys that are, they're on the fixed income desk in other places around the world, and they're all, making trades based on their future prediction of where U.S. Treasuries are going to be. But in addition to that, they're also scalping all day long. They're taking HFT trades, running programs, and looking for areas of, like I said, strength and weakness. So it's a combination. You have some larger players who need to fundamentally execute an order because they need to be in now, just due to where the yield curve is or where the percentage rate is. You have banks which offer liquidity for that. So you might have a guy in Japan or Hong Kong or Australia who wants to work a very large order, let's say, of 20 or 30,000 contracts, but he doesn't want to go into the market himself. So he calls up his guy at Goldman or wherever, and they quote him a price. And he executes at one price, and then Goldman has to execute in the outright markets to hedge their position. Or immediately get flat, whatever the case may be. You can be sure whatever price they quote him, they're going to make money overall. So, actually, it's funny. There's a guy in here who he and I have had this conversation many times. He's familiar with this. But basically, a guy wants to sell 20,000 contracts. Well, he knows that selling them outright is going to dump the market off 6 ticks or more. Possibly even more than that, right? He just wants to move them at once and be done with it. Goldman will buy them at a discount. So Goldman will, quote him a bid that's lower than the inside market. So he gets a worse price, but he gets it all done at once. And then Goldman, they take his sell order, and then they work the trade off themselves, But basically, so you have stuff like that, not to go into too much detail, but you have banks that are working the other side of the order, and then they hedge, and you have those guys running HFT programs in certain areas, and you have fixed income desks who just need to do something because they're taking on a position for the next year, et cetera, right? And then you have a lot of heavy speculators. I mean, you have guys that are trade 2,000, 4,000 up, and there are multiple guys around the world like that, and they all are looking for the signs, Can I hold this spot? Can I not hold this spot? Like the flipper, in those interviews. And see, so the flipper is not, while he was sort of a phenom, he's not a unique snowflake. I mean, if you've ever, you can't see it now because everything's electronic, but, if you look at the days of the pits in the 80s and the 90s, I mean, the bond pit and the 10-year note pit were massive pits. I mean, there would be stuff going on one side that you couldn't even see on the other side, right? There are trades going off, and all the guys in those pits, for the most part, were trading at least 50 up, if not more. And you had multiple guys that could swing several hundred to several thousand. So now you drop them into the ball game, and there'll be some areas where those guys just kind of sense, like up here, they sense some weakness, and they just start dumping off 2,000-3,000 contracts. And then if one guy does it, he triggers 2 other guys to do it, and they're just outright speculators. And maybe they buy some in the 30-year to hedge themselves at the same time. But everybody's pretty much basically looking for the same thing. Everybody's looking for pressure in one way and the path of least resistance. It's just those guys have 2 advantages. One is their orders can actually become the support and the resistance, and they know that. So they know if they pick the right spot, there might not be a lot of people there, but if they know they have some guys at their back, they can bid up 3, 4, 5,000 and just hold the market until it turns around a little bit, and then start working off orders as it turns around. In addition to that, they can also see for how much of the size they account. So, if a guy, maybe if he's working a bid of 2,000 and there's only 2,200, let's say like this, on the bid, he's most of that bid. So if someone plows through him and he gets filled on his order, it lets him know that, okay, there are sellers willing to dump off 2,000 here pretty easily. And then he sees what happens underneath him. And if he sees that the bid underneath him pulls away real fast, he knows he doesn't have much at his back. And he can turn around then and start working sell orders to get out of that long trade and possibly even reverse and go the other way. I discussed that like in my YouTube video, "Is Scalping Legit?" There's an interview with Tom Baldwin and he talks about that. How size can be a disadvantage sometimes when you're hooked, but then it can be an advantage because you can often turn around and go the other way. And that just the fact that you're exiting your losing trade is going to send the market probably 2 or 3 ticks higher. So why am I going to just exit whenever I can reverse, knowing that my size is probably going to carry the market a few more ticks and I can make back the money that I just lost? Whereas obviously smaller traders don't have that knowledge, that foreknowledge. Right? So if you knew that you were about to drop 4,000 or 5,000 on the market at a certain price, no one else knows that. They're all waiting for you to do it. You know what I mean? That's why markets sometimes go and sometimes don't go. But if you know that you're about to do that, then you can work orders 1 to 3 ticks right above that and just bang it. And because you're pretty sure it'll set off stop orders, right? So while everybody trading 1 lots through 200 and 300 lots, and really even 500 in the 10-year, while all those speculators are waiting for the guy to drop the hammer, the guys who can actually drop the hammer know that they're about to drop the hammer. So they get positioned prior to that, then they drop the hammer and they're already working their exits underneath. And they get filled as the market cracks on their movement. The rest of us are just trying to make an educated guess based on that. And then we hope the guy drops the hammer. And if he doesn't, we just have to get out and, take a small loss. And that is why what you're electing to do for a living is completely crazy. It can be done, but I mean, really, when you take that into consideration, what you're actually trying to do, it's a pretty crazy way to try to earn a living. The saying is, it's a tough way to earn an easy living. That's the saying. All right. A couple things just came to mind. I know too how, obviously everybody who takes my webinar, they typically understand the idea behind trying to minimize your risk more and pick better entries and exits so you don't have to take a lot of risk, right? And that's the whole idea behind day trading. And, some people who are new or who have predominantly been technical traders, they come in and there are some days where the idea is that even if the market is trading 6 or 7 or whatever off the open, or they figure, well, I can just buy in here and I'll just hold unless it goes through the low, and if I had just bought and held all day long, I would have made money. And they go back to yesterday and they think, well, if I had just, sold when it snapped lows here and held all day long, I would have made a lot of money. But it's rare that you get runs like that, and it doesn't take any consideration or take into consideration how quickly momentum can turn around, how quickly a market can go from highs to lows or lows to highs. And there's just not really an edge in it. You really are just throwing darts and trying to keep your risk to reward right. But even then, it's like it doesn't matter because your risk is so far off that if you hit a couple of bad stretches, you just bury yourself, you know? So, again, I continue to hope that as we've talked through how this action has behaved, you begin to see, yeah, I can see that. Okay, I can see how that absorption of that backtaking stopped the market. I can see how right there they had tons of momentum and the market was cranking lower, you know, and you would want to hold your trade or definitely not go long. I can see how it took too long for them to try to buy 16s and how easily the market held just above that and how we saw this big order over here in the 5-year and the market retraced. You know, I mean, it all makes sense from a volume standpoint. And that's the stuff that you can't see on charts or moving averages or MACDs or, you know, everything else. I mean, even if you have like pivots and VWAP and everything, those are just prices. You can't see how the bids and the offers are reacting, how the prints are taking place. Is there absorption on a price? Are they moving through it very easily, etc.? That volume is ultimately what dictates movement. So, you know, hopefully, again, even though today has not been that eventful, you gain a little bit of knowledge in terms of how that market stopped. And then, of course, on the downside, how the profile built. That was a little, like I said, it's a little less reliable, but you can at least see how heavy volume began. There was more heavy volume trading here than there was in between 15 and 12.5. And then that turned the market around, and now it's back up at highs. So I want to clarify something, because I did have it right, but this will help explain to you when you're talking about institutional trading, right? So this is the kind of stuff that you don't ever see. You see it, but you don't understand what's happening when you're talking about big players and why the market does what it does. Let's say a person wants to sell 30,000 notes, 10-year notes, okay? For whatever reason. Their banking is off some way. They have an idea about policy, whatever the case may be. They don't want to go in and work that order themselves. They call up Goldman and they're like, I need to sell 30,000. What can you quote me? So Goldman's not going to give them 15.5 where the market is, right? Goldman's going to quote them maybe 13 or 12.5. It's going to be off the market. And they eventually come to an agreement, you know, and the guy says it's sold. So what happens is Goldman is instantly long 30,000 contracts in the 10-year. They're also instantly in the money. However, they don't want to be naked net long on 30,000 contracts, you know, on the chance that some kind of event transpires or momentum picks up against them. They don't want to have that market sink against them and go through them when they're still net long 10,000 contracts or something, right? So what probably happens, and it all depends on the day and the time and, you know, who's working the order desk and everything else, but is before they even buy the 30,000, they know they've got a guy on the hook and he wants to sell 30,000. They're like, all right, let me hedge myself on the off chance that when I buy this, the market instantly collapses. So they might sell some in the 30 and the 5. They give this guy his order. They're now long from, let's say, you know, 12.5 or 13. And immediately they go into the market and start selling off size. But they can't just sell off 30,000 because that'll bring the market right back down to 12.5. So they begin working both sides in an attempt to maneuver out of 30,000 contracts in the 10-year. See? It's completely unrelated to fundamentals or news or even levels, you know, prices, moving averages, whatever. It's just, but it creates movement, you know, because that's a lot of size that has to be moved. So that kind of institutional trading takes place and you never see it and you don't know why it's happening and it doesn't matter. What matters is as Goldman is moving those contracts trying to get flat and pocket their profit, you know, risk-free basically, can you find an area where you see what's going on and you see that they're sitting on 15.5 or 15 maybe and you get short as they sell off 5, 6, 7,000 contracts at 14.5, 14, and 13.5, you know, or vice versa on the upside. That's how major players work with that kind of order. You know, at different times of the day, they'll just be running the HFTs and looking for, you know, where they are and how much size it seems to be taking to move the market, and then figure, well, can we move the market 5 ticks here and make a profit, or is there just too much size? Is this, you know, not the best place? But it was funny, somebody commented on one of my YouTube posts, and they said, I mean, are there really people who trade 10,000 contracts? Yeah, there are. But they're spreading, they're hedging, they're working institutional orders, etc. But they're there, you know, and that's who you're not up against. I mean, you are up against them, but you're obviously not playing against them. You're trying to figure out what they're doing. I mean, that really is the whole key. And then figure out whether smaller orders will feed off of their larger orders, you know. That's pretty much all that's involved in trading, period. Also got a suggestion for you guys. It's not the greatest documentary, but there's a few interesting parts to it about how the Federal Reserve creates monetary policy and what effect that has on booms and busts. It's currently on Netflix, if anybody has it. It's called Money for Nothing. It's a big picture of Bernanke on there. His beautiful face. But what was interesting was they had a clip of a news segment that took place several years ago, and they were interviewing this hedge fund manager who had made like $7 billion, something stupid like that. And I think it was Maria Bartiromo at or where's she at? CNBC or something like that. I can't remember what station she works for. She's like, well, how did you do it? And he goes, because I couldn't lose. And she's like, what do you mean? I'm paraphrasing, but you should watch it just for that. Or if I can find the clip on YouTube, I'll try and send it to you. But he basically said, you know, Bernanke told us what he was going to do. He goes, I knew there might be some fluctuation, but basically, I mean, if the market went down, they were going to do quantitative easing, which would then take the market back up. And if they didn't have to do quantitative easing, that meant the market was going up. So it's what's called it was originally called a Greenspan put, and then it became what's called a Bernanke put, like a put option. You know, so he just plowed everything that he had into the stock market and, you know, made fortunes for lots of people, including himself. That's like how fundamental long-term stuff works. And it's just good to kind of have a background in that so you understand long-term stuff and then how that can affect the short-term. It's also a good follow-up to the Q&A that we had last week that I'll be sending to you. I'll try to get that out today. Where I was talking about the difference between me and Linda Raschke. Someone had talked about, you know, scalping and then swing trading or long-term trading. You know, it very clearly demonstrates the separation there between being a person who is trying to day trade, you know, and make a living versus being a person who is running a hedge fund with 500 million or $1 billion under management, getting 2 and 20, and just positioning themselves the right way because because Bernanke lets them know, even if the market falls off, we're going to do QE3 or QE4 or QE17, you know, and we'll stimulate the stock market. Don't worry about it. You know, yeah, just, okay, I got $1 billion, we're long $1 billion, you know, wait for it to go up. Totally different world. And one that you usually only get into if you have been to Ivy League schools and then networked with the proper people while you were there. Or your family was there. It's not always the case. Some guys, come from City College, like Gordon Gekko, and make it, but getting into that world and around those types of people who have that much money to invest, it's just a completely different ballgame. Question, how do prop traders look at 10 different depth of markets? How do they get a feel for it? It's just practice, man. It's just practice, I'm telling you. It seems impossible when you first undertake it, and then eventually you start to get it. It's really like riding a bike. You can intellectually understand what you need to be doing, but you have to do it enough that you sense it, that you build muscle memory, basically. And the same thing happens with your eyes and your brain with regards to watching the depth of markets. Intellectually, you may know that I need to be watching the 4 inside prices all the way across, and then keeping in mind where my profile steps are and this and that. And it seems like I can't do that. I can't do it. It's brain freeze. And then you just shut down. And then you go, okay, where are we? Let me get comfortable. Oh, there. Oh, my lovely charts. There you are. How I have missed thee. Yes, that's all I need to know. Let me just place a sell order up here, and then if it goes to 20, I'll bail out. That's pretty much what happens in the beginning. So that was my sad attempt at humor. Hopefully you're entertained. My calling was not being a stand-up comic. But that's how it works. And if you will just fight the urge, just fight it, and watch them, watch multiple depth of markets for 21 days. Do the 21-day method, right? The theory, which I don't believe is scientifically proven, but I do get, the longer you do it, the more adept you become. The theory is if you do something for 21 days, it becomes a routine. It becomes more habitual and instinctual. So turn off your charts for 21 days and then come back and talk to me and tell me what you learned. You won't be a genius, or an expert, but you will be surprised at how much better you are at scanning across 3 or 4 of them. Obviously it can be done. You listened to me this morning. I'm sure pretty much everybody was probably watching the 10-year, and we were watching the 16s. And I was watching 16, but you saw me immediately go, look at this, they got this order on the 5, and they're not taking the 30 up. I saw all of that at once, basically. So as most people are watching the 15 half 16s, and they go through, what I'm watching is the fact that the 30-year was struggling and couldn't even get to 17, and the 5-year was moving up, but it ran into that big order that didn't even move. So, you can do it. It can be done. I'm not special in any way, shape, or form. It's like I showed you that picture of the guy who looked at 13 depth of markets. You just have to do it. That's it. Like Nike says, just do it. Yes, the comment is you have to get a feel for 10 different instruments and be in the flow, right? And it doesn't have to be 10. For these purposes, you need 3. And here, I'll show you something. Hold on a second. This is my normal workspace. So I have 4. I have the 10-year, the 30-year, the 5-year, the ultra, and then, depending on what's happening, sometimes I'll pop up the S&P over my Ultra to have a glance, sort of see what's going on there. Again, because I do want to know if the S&P is cracking 2100. You know what I mean? That's useful information. And you pop down. So this is how I normally trade. I like to use the other layout because the ultra is useful at times, but it's useful like 15% of the time. Maybe 2 days out of 5, there will be 3 trades that I initiate based on the ultra, but they're good trades. It's a good heads up. So it's worth having that platform up. But when I'm teaching, you don't need to be watching the ultra, and I prefer to have the snapshots up for you so that when I'm doing the trade recap videos, it's very easy for me to demonstrate how offers and bids were pulling and stacking. Like yesterday was a great example of that. If you watch yesterday's trade recap video, great example of watching bids pull away as offers were hammering the bids, and then watching the offers stack up, and again watching a lot of red, a little bit of blue, a lot of red, a little bit of blue, as they were taking it down. So it just makes for a better educational tool, having only 3 up with a snapshot. But this is normal for me, and it's just, you'll learn how to do it. It just takes practice. All right, so in relation to what we're seeing right now, if the market is near the high, as it is right now, at times we think they're sitting near the highs, they're likely to take out the high, versus other times it's not working out, they're probably going to throw in the towel and the market's going to go back down. Excuse me, sorry. So what do we look for? Again, what you're looking for is context, and the context here is that you don't have much happening. So this is where you have to determine whether or not you even want to be involved. And this is, it's funny, a guy actually just wrote me an email a day or two ago, and he was looking into different types of software. He's not a webinar participant, and he had mentioned a few of them, which I won't name, and he's like, "What's the difference between Jigsaw and this, and this, right?" And some of them are fine. Some people like them. Some of them are a little bit sketchy. So the point that I tried to make, I said, was, some of these guys advertise like their software is going to pick winning trades for you. And I'll tell you right now, it's not going to do that. It not consistently. But what a lot of not just software developers, but even other educational material doesn't take into consideration is the context. So I said you have to understand that a volume-based trigger that's strictly based on volume might work well in the morning when it's hyper volatile and there are a lot of people trading, and it might fail miserably in the lunch hour because there's nobody there. So what do I mean by that? Well, I mean, you have a program or something that might be reading, okay, if they blow through 2,000 here, then I want to get long because that's the volume. There's 2,000 there. We're at the high. I want to get long. It's going to go higher. But it doesn't take into consideration how is the market trading just underneath that, and what time of day is it, and what are the odds? In this scenario, it's why I didn't buy 16s. Whereas going into the day, I was looking at buying 15 to 16 possibly. I'm like, okay, if they get there, they're probably going to go through it. I took the big picture into perspective, and I looked at the context, and I went, I don't know now that I want to buy this. And then, of course, whenever it stalled, I was not wanting to buy it at all. I was looking for a short trade. And if it's just volume oriented, obviously it's just going to trigger off of whatever the volume is showing it. So the trick here, in my mind, really, if I wasn't doing Q&A with you, we weren't doing this, I would have already turned off my screen. Either I, would have tried to catch the short trade this morning, and made a few ticks, or I would have missed it like I did, and I would have looked at this market and went, It's just not happening. It's not there now. I missed my very few opportunities that I had, and I choose not to get involved at this point. That's how you come to a determination as to whether or not you want to play. So realistically speaking, it's a coin flip as to whether this market will go from 15.5 to 18.5 or 15.5 back to 12.5. You might give a slight edge to the sellers considering how they have set here, but it's a different day now. So I mean, technically it's not a different day, but I keep using this example so you understand what took place between here and here, right? All of that basically has to be viewed now as a separate day from what takes place from here forward. Because everybody that was involved in this, all the speculators were flat. If you were long, you covered. If you were short, you blew out for a loss. If you were short, you covered. If you were long, you blew out for a loss, or you worked out of these trades right in here trying to get flat. If you were trapped, like maybe you bought 15s, 14s, the market drops, you average in, it comes back to your price, now you average out. So this has to be viewed as almost a separate day from what you're seeing now. Naturally, the resistance is going to be at the previous prices, but you don't have any momentum one way or the other. And there's no reason that we can see, again, that sellers would want to come in and sell 10,000 contracts to drive the market back to 12. Nor is there a reason that we can see that buyers are going to want to set off, trigger stop orders and buy 10,000 contracts to run the market to 19. There aren't any clues. I don't think. Based on what we're seeing. I don't think there are any clues. So, whereas earlier today I thought there were some clues. So if I don't see any clues, I don't trade. Okay, so just to sort of bring home the reality of this, and again, I'm never trying to be, dissuade people from trading or negative or something like that, but you kind of have to understand the big picture in order to get this. So last week I was having a conversation, we were on here, and somebody was asking about possible expected results, and I was saying that it varies a lot. Obviously, you can blow out your account if you don't trade well or if you hang on to losers forever or whatever. But you can do 100% or 200 to 300% a year, and you can actually do 1,000% a year. But it very much depends on market conditions and how well you're trading overall. Obviously, right? And then the gentleman, he was looking at it from a perspective of, well, I mean, if you made 200% a year, 300% a year, and you compound that, you would be a billionaire. So I wanted to kind of clarify what I meant by that, and I did with him. But it does make a really good point that I want to sort of explain to you. So I copied what we had talked about. So let's assume, for our purposes here, that you have a $50,000 account and you make 200% after commissions in 1 year, and that's a good year, So you make a profit of $100,000. Trading profits are taxed. Now, how they're taxed obviously depends on what country you live in, whether or not this is a side business for you, or whether or not you can declare professional trader status as your only source of income or your main source of income. In which case the taxes vary somewhat, okay? But realistically, if you make $100,000, you're going to probably have at least $25,000 come out for federal taxes, and then maybe state taxes if you live in a state that has a personal income tax. You actually don't pay Social Security and Medicare on trading income here, but some people elect to do that anyway. But again, it just depends on your situation. Either way, that's a ballpark figure, and it's actually kind of low. But let's just say that, all right? So you make 200%, 100 grand. You got to take off 25,000 for taxes and Social Security, Medicare, or whatever. You now have 75,000 left, right? But you have to pull out 50,000 to pay for all your bills. There's a Freudian slip. All your beers for the year. All those beers, vodka, and red wine that you drink. You got to pull out 50 G's for that. So 50 G's for your bills, and maybe take a vacation, right? A few $4,000 or $5,000 for a vacation, whatever. And that's in today's world, that's low. I mean, inflation has really gotten out of control. And the price of products and services are just continuing to go up. But that's another topic unto itself. So now you have 25,000 left out of that 100 grand. You leave it in your account. Your 50,000 account has increased to 75,000. You made 200%, but your account only increased by 50%. See? And now let's say the next year you're not trading well, or there's bad action or whatever. You only make 100%. You have to pull out your 50 grand to cover all of your expenses. Plus, you're not going to even have 50 grand. You're going to have left after taxes. And your account still stands at 75,000. So you have a 200% year, and you have a 100% year, and your account is only increased by 50% total, right? So for most people, you can't assess it like a fund manager reinvesting all profits, excluding taxes or deferring taxes. Most people who trade, they're trading between, a 5,000 account and maybe a 100,000 account, and they're planning on trying to make enough money to pay their bills with trading profits. So you can see, like, from a percentage perspective, how it's, you have to make quite a bit of money. Now, what happens with most traders is if they hit it, they have 1 year where they crush it for, 1,000%. And you end up taking 50 grand into $500,000, or, 100 grand into $500,000 or whatever. And now you've really put yourself out there. You have a bankroll, and you can float yourself through drawdowns or through more dead periods when you don't have those kind of returns. And yeah, there are true stories about people who've run, $5 grand into $500,000. I mean, that does happen. But you have to be on a pretty phenomenal run and phenomenal market conditions to do that. Somebody said, "What a wake up call." It is, though. See, and like that's, again, I mean, it can be done. People do it, and everything that I'm teaching you will help you in terms of making better decisions, minimizing drawdowns, identifying better context, all that good stuff. So it can be done, but you have to be realistic about it and understand. Because what happens with most people is that, they hear the stories about, well, I can turn 10 grand into $1 million. And I mean, yeah, occasionally somebody can do that, over the course of maybe two or 3 years if they have just an outstanding run. But most people just get into it with this idea thinking that, if I put 2 or 3, 4 grand in an account, I can trade a 2 or 3 lot and I can just scalp out 200 a day and make 50 grand a year, and that just doesn't work. And they're not really thinking about like the big picture. I mean, 100 or 200% in a year return, I mean, is unheard of in most businesses, but yet very doable in this business. But still, making 100 or 200%, unless you have a big account, once you pull out for taxes and living expenses, that still doesn't get you on the path to multimillionaire status. You know what I'm saying? Um, so that's, really that's why every tick matters too. Every tick counts. I mean, you're looking at the year-end results. You want to increase that return where you have a good year and you make 100%, but you could have made 130% if you had saved those ticks. Or that's why every little piece of the puzzle matters.